You've probably heard the warnings the market is too concentrated. A few tech stocks control everything. And yes, the numbers are eye-opening. As of late 2024, the top 10 stocks in the S&P 500 make up over 35% of the index. That's huge. To put this in perspective, just 10 years ago, it was only around 18%. But here's where it gets interesting. AQR's research shows something counterintuitive. This concentration might not actually mean higher risk. Let me explain, and today's letter will be a real discovery for all of you, so please watch till the end. Look at this fascinating chart. If market concentration really led to higher risk, we should see the blue line trending upward from 2015 to 2024. But surprise it's not. The market isn't actually becoming more volatile, despite the growing dominance of these mega-cap stocks. As AQR puts it, rising weights for the largest companies don't necessarily equate to more concentrated risks, if those large companies are themselves very diverse. Let's talk about everyone's favorite topic, the Magnificent Seven. In 2024, these tech giants, Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla continued their market dominance. Check out these mind-blowing numbers. In 2024, Nvidia alone contributed almost half of the entire market's return. That's one company driving nearly 50% of gains for the whole S&P 500. Now let's break down the fascinating battle between two very different types of investors. Traditional stock pickers, discretionary managers, are what most people think of when they imagine fund managers. They're the ones who do very deep, I hope, research on individual companies, make big bets on their strongest convictions, typically hold 30 to 50 stocks they really believe in, rely heavily on human judgment and analysis. On the other hand, systematic quant managers are like the money ball of investing. Use computer models to analyze thousands of stocks, make hundreds of smaller bets instead of a few big ones, keep their portfolios balanced across industries, and let data drive their decisions rather than gut feelings. And guess what? In this new concentrated market, the robots might be winning. From 2022 to 2024, systematic managers achieved a median return of 0.2%, while discretionary managers saw minus 1.3%. In average, not my great alpha. Check out this fascinating chart showing how quant managers actually make money. Instead of hitting home runs with a few big winners, they get lots of small gains across hundreds of stocks. See those bars in the middle? That's where the magic happens, tiny wins and losses that add up to overall success. It's like the difference between trying to win the lottery versus running a successful business. Small, consistent gains beat dramatic gambles. Why? It's all about diversification. Imagine you are a chef with 5 different recipes. The old way of cooking was to use the same amount of each ingredient every time. But what if you could have a smart kitchen that learns which ingredients customers like best and automatically adjust the recipe? That's exactly what modern quant managers are doing with their investment signals. Look at how the colored bands change over time. As new signals are introduced, the system automatically adjusts their importance based on how well they are working. It's like having a self-improving recipe that gets better over time. But why teaching computers to invest is harder than teaching them to recognize cat pictures? There are 3 big challenges. First of all, signal-to-noise ratio. Imagine trying to hear a whisper at a rock concert. That's why finding real investment signals in market data is like. The moving target problem, second problem. As soon as everyone figures out a trading strategy, not telling you to, it stops working. As the paper puts it, as new signals are discovered and exploited, they quickly become absorbed into market pricing, reducing their effectiveness. The third problem is limited data. Unlike teaching AI to drive cars where you can generate infinite practice scenarios, in finance, you're limited to actual historical data. You can't create fake market crashes to train your models. Maybe you can accrue one 9087. Here's a cool concept that smart investors use, Bayesian learning. Imagine you're a detective who starts with a theory, but updates it as new evidence comes in. That's exactly what modern quant systems do. They blend their initial assumptions with real-world results to keep getting smarter. And speaking of getting smarter, check out how momentum investing has evolved. Old school, but just buying what went up recently. New school, analyzing earnings momentum, analysis, forecast changing, economic linkage between companies, natural language processing and using reports, even momentum in other investment factors. The paper drops this fascinating bombshell. The old way of grouping investment strategies into neat boxes like value or momentum might be outdated. Modern signals are so complex and interrelated that they defy simple categorization. It's like trying to categorize modern music. Is it pop, electronic, or hip hop? Sometimes it's all of them at once. But here's where the future gets exciting. AQR reveals how investment firms are using AI and machine learning in ways you might not expect. They're not just analyzing stock prices, they're processing alternative data sources like transactions data, developing sophisticated machine learning models. But there is a catch, as the paper wisely notes. Unlike fields with high predictability, such as name recognition, financial markets have a low signal-to-noise ratio and are dynamic, making it difficult for machine learning models to maintain accuracy over time. So what should you, as an investor, take away from all this? Short summary. First of all, market concentration is not necessarily as risky as headlines suggest. Second, diversification matters more than ever. Third, technology is changing investing, but it's not a magic bullet. Fourth, the future belongs to those who can blend human wisdom with technological innovation. Let me leave you with this powerful quote from the paper. A small advantage spread across many unique bets provides a quant manager with conviction, rather than relying on a concentrated all eggs in one basket strategy. And you can see my verified outperformance of S&P 500 index as the portfolio manager right here, right from Interactive Brokers broker. And that's all for today. Hope you understand and it was enjoyable for you investors. If you found this analysis helpful, don't forget to like, subscribe, and hit that notification bell. Drop a comment below with your thoughts on market concentration. Are you team human or team robot when it comes to investing? Thank you.